Welcome to our presentation on the BCI Business Brokers Business Valuation Model. So I want to stress at the outset that this is an overview, and we don't intend to deal with any particular part of this diagram in detail. If you're looking for detail, go to valueabusiness.com.au. So the threshold question at the top of our diagram is the business making the money? And what is that amount of money that is made? If we come across on the no, that's not fatal to the cause. The next question is, does the business have special value? Special value, we're talking about maybe something that doesn't relate to profit, obviously doesn't relate to profit. Could be intellectual property, patents, trademarks, a database, a way of doing work, key staff, contracts with particular people, relationships, all those sorts of things that may not be producing income but could have value to an acquirer. If there's no special value, we're going down to the asset method. Now, there's no clear agreement on what these different asset methods are called. The first one is depreciated value, which, as you might think, is the value of the equipment according to depreciated values in a depreciation schedule attached to a balance sheet. Next up the ladder of value is net realizable value. What could be achieved by selling the assets after costs in the marketplace in an orderly sale? Not a fire sale, you could probably squeeze that method in as well. Fire sale valuation, immediate sale at whatever cost. And a going concern value is the highest value of assets. In other words, the assets are in situ, they're plugged in, they're working, there's people ready to work the business, and it hasn't been dismantled and all collected and left to sell at an auction house. So it's going concern value of assets. Similar to the going concern value is the cost to create. In other words, here, in similar terms, what would it cost to put this business in place where it is today? In that location, with a lease, with the equipment all installed, what's the cost to create method? Now, let's come back on, is the business making money? Yes. We still ask the question, does it have special value? Because it might have value over and above its value according to a profit method. If it has special value and you think that that takes it right outside the value that could be arrived at by looking at profit, well then let's look at that special value. You may not work that out until you then go down and look at one of the income methods to see what value that throws up. So let's assume that there's no special value, or at least we're going to go and have a look at what the business is valued at according to an income method. There are two sort of broad categories of income here. A business that makes wages for an owner, and a business that does more than that, makes wages for the owner plus profit. So it makes wages for an owner. There's a lot of small businesses out there that owners just see as their wage. So it's what might be called an owner's return, or as we call it, the method to value a business according to such an income stream is the simple profit PBIT multiple, proprietor's earnings before interest and tax. As I say, many businesses are valued according to this. Let's work out what the owner gets out of the business and apply a profit multiple, which will be a larger multiple than an EBIT multiple, and we'll come to that shortly. So that was making wages for the owner. Now let's look at where a lot of the larger businesses fit in, because the owner's wage isn't as relevant here. Making wages plus some decent sort of profit. So we're looking at a genuine profit multiple here. The owner's been paid the correct amount, staff have all been paid, associated people have all been paid, and the most used method and the most recognised and accepted method here is capitalisation of future maintainable earnings, often shortened to the FME model. So what is that profit figure? And then we find a multiple to apply to that profit figure according to risk. risk of those future incomes not being maintained. There are other methods to look at here. We're just talking about profit at the moment, but to the left we're talking about discounted cash flow. This is a method whereby mostly accountants will use this, but anyone can do it, setting up a spreadsheet, counting the cash flows into the future, a number of years, just cash flow, cash received, cash paid out, projection of those, so future cash flows, but discounted to their value today. And that is a spreadsheet that anyone can set up or look on the internet for discounted cash flow, or shortened to DCF. The third method, and there are many others, but I'm just trying to summarize the main ones here, is the super profit method. Super profit looks at different rates of return for different asset classes. You might have a typical example of a real estate agency that has income stream from sales and income stream from property management. Income, those two streams are certainly treated differently as far as EBIT multiples are concerned. And finally, our last test, the sanity test, the genuine market test, what are businesses selling for like this in the market now? So there's our BCI Business Brokers business valuation model. For more detail, go to valueabusiness.com.au.